Imagine waking up tomorrow morning, opening your banking app, and seeing your balance is still there. Not reduced, not stolen, still intact. But every button is disabled. Transfer blocked. Withdraw unavailable. Card payments declined. No alert. No email. No crime. No explanation. Your money exists, but you are no longer allowed to touch it. And the most terrifying part? This isn't a glitch. This isn't an error. This is not a malfunction. This is how the system is designed to work. This is a story from the Fortune Ledger HQ. There was a time when the idea of a frozen bank account would have sounded absurd. Money was physical, heavy, real. If you owned gold, no one could pause it. If you held cash, no authority could remotely disable it. If you buried your wealth beneath the ground, it stayed yours until you returned with a shovel. Ownership was absolute. Control was personal. Money answered to the individual, not the institution. But absolute ownership came with problems. Gold could be stolen. Cash could burn. Physical wealth could disappear overnight. So banks offered a deal, not a demand, a promise. They promised safety. They promised convenience. They promised speed. Give us your money, they said, and we'll protect it. At first, nothing seemed to change. You could still withdraw it. You could still spend it. You could still access it anytime. The illusion was perfect. What people didn't realize is that the moment money entered the banking system, its nature changed. Not technologically, legally. The day money entered the bank was the day it stopped being fully yours. Most people believe their bank account is a digital wallet. It isn't. Legally, when you deposit money into a bank, you are not storing it. You are lending it. The bank takes ownership of the cash. You receive a promise in return. A promise that says, when you ask for your money back, we will give you an equivalent amount. That promise is recorded as a number on a screen. That number feels like ownership, but it isn't. It is a claim, and claims can be delayed. Claims can be challenged. Claims can be suspended. This is not a conspiracy. It is basic banking law. Your bank account is not a vault. It is an IOU, and IOUs come with conditions. Conditions written in documents no one reads. Pages of legal language that quietly say, access is not guaranteed. Services may be suspended. Funds may be restricted. Reviews may be indefinite. Explanations may not be provided. You agreed to this. Not consciously, not deliberately, but legally. The illusion was never that banks stole money. The illusion was that you owned access. You don't. Access is granted. And what is granted can be revoked. Banks are not neutral guardians of wealth. They are risk engines. They exist to survive regulation, penalties, and collapse. And that survival requires control. Banks like to present themselves as neutral institutions, safe places, trusted middlemen. But modern banks are not vaults. They are risk management machines. Every decision a bank makes is guided by one question. What exposes us to punishment? Not what is fair. Not what is human. Not what is reasonable. What reduces risk? And in today's financial system, the greatest risk is regulators. Governments fine banks billions for missed suspicious activity, delayed reporting, inadequate monitoring, allowing risky money to move. So banks adapt. They don't investigate first. They freeze first. Because freezing protects the institution. If a bank freezes an innocent person's account, nothing happens. If a bank fails to freeze a flagged account, everything happens. This is the logic that governs your money. Banks are required to monitor behavior continuously, not occasionally, not when something goes wrong. Every second, every transaction feeds into anti-money laundering systems, counter-terror financing databases, fraud detection engines, sanctions lists, behavioral models. Your financial life becomes a data stream. And data streams are judged by patterns, not context. An algorithm doesn't know why you needed money urgently, why someone helped you, why your income changed, why you moved funds quickly. It only knows deviation. And deviation equals risk. This is why freezes feel sudden. From your perspective, nothing happened. From the system's perspective, everything changed. A threshold was crossed. A pattern broke. A rule triggered. And once triggered, reversal is slow. Because reversing means responsibility. There is a dangerous myth that humans decide when accounts are frozen. In reality, humans are often the last to know. Modern banks rely on automated systems that flag, score, rank, restrict. Before a human reviews your account, the system may already have disabled transfers, blocked cards, limited withdrawals, logged reports to regulators. By the time you call customer support, the decision has already been made, and customer support has no power to override it. They read scripts. They escalate tickets. They wait, just like you. These systems are designed with one priority. False positives are acceptable. False negatives are not. Meaning, it's okay to freeze innocent people's money. It's not okay to miss suspicious activity. So the system is biased toward restriction. Over time, this bias becomes culture. Freezing becomes routine. And here's the part most people never hear. Many freezes are not triggered by what you did. They're triggered by someone who sent you money, someone you sent money to, someone in your network, someone in your country, someone in your industry. Risk spreads by association. Guilt becomes contagious. Once your account is frozen, it enters a black hole. Compliance review. That phrase sounds procedural. It isn't. Compliance reviews have no fixed timelines, no guaranteed outcomes, no obligation to explain. Banks are often legally prohibited from telling you why your account is under review. This is called tipping off, meaning they know, you don't, and they cannot tell you. So you wait. Days turn into weeks. Weeks turn into months. Your money sits there, untouched, unusable. And here's the cruel irony. Your frozen money is still working. For the bank, they can invest it, lend it, count it as capital. You bear the cost of immobility. They bear none. This is not a theory. Across the world, businesses miss payroll. Families lose housing. Students are expelled. Medical procedures are delayed. Lives unravel. Not because of guilt, because of the process. And the process has no face. Many people describe the same emotional arc. Shock, confusion, shame, fear, powerlessness. You start questioning yourself. What did I do wrong? Sometimes the answer is nothing. Cash was incompatible with this system. Cash could not be monitored in real time, flagged automatically, restricted remotely, programmed with rules. Cash represents freedom, so it had to be reframed as dangerous. Cash equals crime. Cash equals corruption. Cash equals risk. Limits were introduced. Withdrawal caps. Reporting thresholds. Cashless incentives. Until digital became default. Digital money is not just electronic cash. It is a control layer. Digital money knows who you are, where you are, what you buy, when you buy, why the system thinks you bought it. And because it knows, it can decide, allow, deny, delay, expire. This is not abuse. This is functionality. Banks are not opposing the state. They are extensions of it. Governments realized something powerful. Why enforce laws directly when banks can enforce them quietly? So enforcement was outsourced. Tax compliance, sanctions enforcement, behavioral control, all handled by financial institutions. This removed political friction. No police, no courts, no protests, just declined transactions. This is the most important shift. In the past, governments seized assets. That required evidence, warrants, courts, public records. Today, they freeze access. No ownership change. No due process. No spectacle. Just restriction. And restriction is invisible. This sentence has comforted millions. It is also false. Systems do not judge innocence. They judge risk probability. Risk includes geography, timing, networks, patterns, correlation. You don't need intent. You need proximity. Banks are rewarded for overcompliance. They are punished for undercompliance. So caution becomes extreme. Extreme caution becomes policy. Policy becomes automation. Automation becomes normal. And normal becomes invisible. Money used to be neutral. Now it is conditional. You don't just have money. You have approved money. Money that behaves. Money that obeys. Money that stays within invisible boundaries. Central bank digital currencies are not just digital cash. They are programmable instruments. They can restrict spending categories, set expiration dates, enforce geographic limits, apply behavioral rules. This isn't speculation. It's design. Freezing becomes automatic, policy-based, instant, no bank needed. At first, people resist. Then they adapt. Then they comply. Eventually, they defend the system. Because survival requires alignment. Power moved quietly. From people, to banks, to regulators, to algorithms. And algorithms do not negotiate. When it happens, it will feel unreal. You'll refresh the app, restart your phone, check your internet, then panic, then silence, and finally, realization. Money is not wealth. It is access to food, to shelter, to movement, to dignity. Control access, and you control life. The most dangerous day is not the day your bank freezes your money. It is the day you understand. They always could. They always had the power. And you only had permission.